Hello and welcome. My name is Sulie Richardson, and I am the Community Education Program Manager at Desert Financial Credit Union. And I'm excited today to be able to bring to you this webinar on dealing with debt. Debt is a four-letter word that can evoke negative feelings and emotions depending on your financial situation. Today, we're going to learn about how to best deal with debt. We're going to talk about the differences between different types of debt, why they occur, and then some possible ways that we can handle them. Then lastly, we're going to share some resources that you can use to help pay down debt and or get out of debt. We do not have to be in debt for the entirety of our lives. I'm a believer in that, and I like to share that with others. Sometimes people just don't think about it that way, but it is possible to live a life that where you're kind of debt free. All right, so first we're going to talk about the difference between debt and credit. Many times we use the terms interchangeably, debt and credit. However, they're quite different. They don't mean the same thing, even though they may evoke some of the same feelings and emotions. So when we look at debt is money you owe, it's a liability, and it may obligate your future income. And here, when you look at credit, credit is the ability to borrow money, and then debt is the result of using credit. And so the next thing that we're going to talk about is good debt versus bad debt. In a classroom setting, this would have been a conversation, usually a group discussion where I ask people about certain debts and just to see, where they stand, their opinions, their perspective. And we're going to kind of go through this a little bit differently because obviously I'm not in a classroom, but we're going to talk about some of the pros and cons in these types of debt. Loan from a family or friend is the first one that we're going to talk about. And the good in that is that you have flexible terms. You might have low interest or no interest. If you miss a payment, they're not going to report you to the credit bureaus. The bad and borrowing money from family or a friend is that it creates conflict, or it can. It can damage relationships. Generally speaking, people don't borrow money with the intentions of, I'm never going to pay you back. They typically want to pay you back, but life happens. People have job losses, a medical situation can occur, something can happen that puts that individual in a position where they can no longer pay back that debt. And then the second one is the car loan. The good from a car loan is that, of course, if you have a car loan, you have transportation, you can get to work, to school, to get around, helps you to build your credit history. The bad from having a car loan, that depending on the terms, it can be unfavorable. Unfavorable. If you borrow the full cash value of the car, it could cause or lead, have you to be what's called being upside down. Typically, when you buy a car and you drive up the lot, your vehicle depreciates immediately. And if you don't have a down payment, you might find that you're upside down. So you owe more on the car than what it's actually worth. And so the next one is the student loans. The good from a student loan is that you get to further your education, can get you a better paying job. The bad side to having a student loan is if you borrow too much and you're in a career that cannot support your repayment plan. So that's the bad side to that. And usually with a student loan, those are not forgivable. You have to pay that. You can't wait it out. You can't file for bankruptcy to get rid of it. You have to pay that loan back. And then the last one is the payday loan. In Arizona, it's outlawed to have payday loans, but what they have done is they kind of repackage themselves. They call themselves something different under different names. But the concept and that same business model is still here. In many neighborhoods, you see a lot of these types of businesses that they operate in a lower income neighborhood. And then the good, if there is any good in this type of loan, is that it can help a person to get cash quickly with little or no hassle. And I can kind of see that if a person is in a situation where they need to have some money like right now, and they know they're going to get a lump sum to go pay that loan off in a couple of days. I get it, because people have lives and things happen. The bad side to having this loan is that you have to pay it back usually within 14 days. A lot of times people get it refinanced, and it's not a good thing. If you give them your bank account number, they will take money out of your account whether you have it or not. And I'm going to talk more about the concepts of these types of loans a little bit later on. And then we've got the mortgage. A mortgage, of course, is good because you get to have a home for your family, you get to own it. Rates are usually very low. And then you've got your collateral when you own that home. And of course, it helps you to build up your credit history. The bad that can be that a person can incur from having a mortgage is if they really can't afford it. And it makes me think about 10 years ago when we had that big housing boom, and a lot of people got into some bad loans and went into foreclosure, and it really negatively impacted their credit history. So sometimes having a mortgage could be bad for an individual if they are not prepared and they cannot afford that home loan. And then next, we've got the title loans, which we have a lot of those here. And the good from that, again, if you need to get some cash quickly and you know you're going to get that money in a couple of days to pay that loan off. The bad from that is that if you give them the title to your vehicle, they will take your vehicle and now you have no transportation. And then we've got the pawn shop loan. The good is that it can help you to get cash quickly with little hassle. But the bad is that if you provide an asset, when you do, if you don't pay that loan back, they'll keep that asset. With all of these types of loans, especially the pawn and the title loans, these types of loans are the reasons why when we teach our budgeting class, our spending plan class, that we always advocate for pay yourself first. We always advocate to build some money into your spending plan where you can have some emergency fund for not if something happens, but for when something happens. And so when something happens, we're not using like title loans and payday loans and pawn shop loans, that we actually have some of our own money that we have set aside every pay for when that emergency happens. And so the next thing we're going to talk about is the rent to own. Rent to own, you're leasing consumer goods. It might seem like it's a great idea because you get that instant gratification to have that new electronics or the appliance or the furniture in your home right away. But it is not a good it's not a good loan, it's not a good agreement. By the time you get through renting that object, whatever that is, you probably could have paid for it three or four times over again. And then the other alternative to, rent to own is that, people can still put things on layaway. Some companies, some stores still have a layaway plan. And if not, you just save up that money until you get enough where you can buy it outright. All right, co-signing has been around for years and years. It could be a little bit tricky because if you're the co-signer for an individual, that means that you now have a new loan. And that is exactly how I explain that to people when I'm teaching in the credit classes, that if you co-sign, you have a loan. Once you sign on that dotted line, I'm obligated to pay that loan as if I was the primary borrower. So co-signing puts you in a position where now your credit is going to be affected because now you have that loan that now shows on your credit report, regardless if the person that you're co-signing for is making that payment every single month. It still shows on my credit as if I have another loan. I am totally reliable for that loan. And so it impacts my income to debt ratio. So if I co-sign for a person, everything is fine. And maybe in 6 months, I decide that I want to get a loan. When the lender goes to pull my credit history, they're going to see on my credit file, they're going to see that I got this loan out there. And it could negatively impact my potential to get a loan on my own. And so the next thing we're going to talk about is medical debt. Medical debt is one of those unfortunate debt that a lot of people go through, and it sometimes happens because of an unplanned event, someone becoming ill, something happens, they're injured. And so even with insurance and copays and deductibles, this can all add up and lead it to people having a huge medical bill. And so again, this is one of the reasons that we advocate for having some kind of monies in a savings account. You know, living beneath your needs and always saving and paying yourself first for when something happens that you've got some cash that can help you to get through that crisis. The other reason that medical debt, that people have this and they go through some struggles with it, is that the cost is almost never fully known up front. Unlike the cost for when you get a car or a house, you know, before you sign on that dotted line, you know typically what the total cost is going to be, what your payments are going to be. With the medical, it is quite different because you don't know. And the reasons for that could be that sometimes the services that we get from our medical profession, some of that is outsourced, it's contracted services, and we don't know. And because you have the insurance companies involved in what as well, where the insurance companies get billed, and depending on your insurance plan and your copay and your deductible, all of those things factor in and add into the reasons on why sometimes we just don't know what the payments are going to be up front. And then the invoicing can be rather confusing because usually sometimes you'll get one bill and you get another bill for another service, and you don't get one bill with all of your itemized costs. You get different bills coming in at different times, and it could be confusing, and you don't know what's been paid by the insurance, what your portion is, and having to wait it out. And sometimes people get confused and then they hesitate on paying that medical bill. And then if you don't have insurance, usually you pay a little bit more than what a person who has insurance and what they're going to pay. Insurance companies negotiate with insurance companies negotiate with medical providers and for a discount rate. So when you come in under a group plan, you usually pay less than a person who does not have any kind of insurance. And the way to avoid a medical debt, if you can, get the cost up front. You kind of want to do that. Find out if they have any kind of discount for paying promptly. Ask for a discount and see if they have any kind of services where you can get a discount. See if they have a charity care that you might qualify for. You can ask and see if they can work out a payment plan that is reasonable, that fits within your budget. What you don't want to do is to probably give them a credit card to put that debt on. You don't want to do that. You might want to just try to work out a payment plan where they probably won't charge you interest. If you use your credit card, know that anytime you use credit, interest accrues daily. And so that can cause a person to suffer unneeded financial stress when they put those types of items on a credit card. So this example that you see on the screen shows how those title loans and how they work. So this information came from an organization called the Consumer Federation of America. They are a nonprofit organization that does a lot of research on like title loans and how they work. And they put this information out for us consumers so that we can understand. So this example shows how a $2,500 title loan, how that is calculated. Those loans usually operate with a monthly interest rate. So this rate shows 17%. It's a monthly interest rate under normal, regular banking terms. We operate under an annual percentage rate. So when you take this 17% monthly rate and you convert it to a annual percentage rate, it becomes the 204%. So this loan for 2 years for $2,500, the payment of $435 per month. Of that payment, only $10.05 goes toward the principal. So when this consumer makes this first payment, of that payment, 425 goes toward the interest and $10 goes toward the principal. This is a very bad loan. It's a very bad loan. Interest on most loans get paid first. So anytime you make a loan payment, the lender is going to take what you owe them first. So when you're trying to get out of debt and pay down on loans, you want to pay that extra on the due date. But this is a bad loan. All right, next we're going to talk about debt settlement relief services. Okay, so these are companies that specialize in so-called helping you out, negotiating for you for on your behalf, on your loan, and they're trying to get it to a lower amount. They want to negotiate so that you can make one payment, reduce the overall loan amount. It doesn't always work. The fee is anywhere between 20 to 25%, and it can also damage your credit rating. They're not always good. It might look good, but that doesn't mean it's good. What they're going to do for you as far as negotiating, you could probably do that for yourself. All it takes is you making that phone call to your creditor, letting them know that you're having some difficulties and can they work with you and work out some kind of repayment plan. A lot of times these companies offer things they can't um, deliver on. So look for the red flags, which are if they say to you that they can, if they, first of all, if they want to charge you before they settle the debt, that's a big red flag. If they tout something that's called some new government program to bail out personal credit card debt, that's a red flag. If they guarantee that they can make your debts go away, red flag. Tell you to stop communicating with your creditor, red flag. Tell you that they can stop all debt collection calls and lawsuit, red flag. And then the last thing, um, if they what they do is they guarantee that they can secure your debts for, and they can, I'm sorry, guarantees that the unsecured debt can be paid off of pennies on the dollar, red flag. Normally these types of places guarantee some things that they cannot provide, and I believe that people sometimes reach out to these types of places because it looks appealing. You get someone to work on your behalf and you don't have to deal with the creditor. If they negotiate on your behalf and they do get your debt lowered, you might have to pay income taxes on that settlement amount because the company who had the loan, they're settling for a lesser amount, but you still have to pay income taxes on that money. So you want to make sure to check into that. And now we're going to look at the differences between the debt settlement services and then what's called a debt management / credit counseling program. There are many nonprofit credit counseling programs out there to help us consumers to get to a better place. They offer credit counseling. They're going to ask about your budget. They're going to work with your creditors. They're going to find out what's really at the heart of the problem. They're going to talk to you, try to work out a plan and uncover what's really going on before coming in and just trying to settle your debt. And they don't do that. They actually want to work with the creditor. So that is different from debt settlement. This is debt management, where even if they take on your case, you might have to pay them a fee, but it's not going to be anything near where you're going to pay for a debt settlement. The nonprofit credit counseling services are actually looking to work with you to get you into a better place. Where the debt settlement services is all about consolidating your debt to one payment and usually working with credit cards and unsecured debt and trying to get those balances reduced. So what you're looking at right now is one of the resources that I talked about that you're going to have access to. And this first one is a debt worksheet. So, okay, so the first thing you want to do when you're trying to, work on your debt is you want to pull your credit report from annualcreditreport.com. Pull your credit report, use this form to document all of your debt, get them in one place, get them organized so that you can see exactly what you owe, the interest rate, you get a total for all of your debt. Then it's going to help you to kind of create an action plan and think through how you want to best approach paying off and getting out of debt. And this next worksheet is called the debt to income worksheet. So when you apply for a loan, your lender pulls your credit, they review that, look at your application, run the numbers. They're also going to use your income to debt ratio to help them to make a decision about whether or not you can afford another loan. So they're going to run the numbers and find out. So this worksheet is for individuals who have a mortgage, and you can also use it for if you are a renter, because the calculations are a little bit different. But you can run your own numbers using this worksheet to see how you stand about um, how you fare with your debt and how much is too much. Then this third worksheet says a debt reduction worksheet. I think I mentioned earlier about how debt doesn't need to follow us for the rest of our lives. So this worksheet will help you to identify your debt and make a plan on how to get out of debt. There's two concepts. One's called the avalanche and the snowball method. One method, you concentrate on the debt with the lowest amount, and you pay extra on that while paying your minimum on all your other debt. And then once you get that one debt paid off, then you apply that payment plus that extra to the loan with the next lowest amount, and you do that cycle over and over until you get everything paid off. Then the other method, which I believe is the avalanche, is where you're going to take the one with the highest APR, concentrate on that, pay extra on that, pay it on the due date while paying the minimum on all your other loans. And then once that one loan get paid off, you're going to take that payment plus the extra and then apply to the next one. And you just complete that until you get them all paid off. So that this worksheet will tell you how to do that and talk more about that. And the other thing I want to say, which I think I might have mentioned already, but I'll say it again because I think you can't hear it enough. If you want to pay down your loans, remember to make that extra payment on the due date. Lenders usually would take what you owe them first, and then they apply the rest to the principal. So pay that payment and then pay that extra on the due date so that that extra payment goes toward the principal. The more you can pay down your principal, it'll help you to get out of debt quicker because interest on loans accrue daily. And so sometimes when debt collectors call, people don't know what to say, especially if they know they owe the money, they don't want to answer the phone. Um, that's legitimate because there are companies whose business is to do nothing but purchase bad debt, and they get it for pennies on a dollar. And so their goal is to get that money at any cost. So they're going to call, they're going to keep calling and keep calling. But what happens now, because this is such a big business, is that there are a lot of fraud, there are a lot of scams, and people get victimized. And so you really want to find out and make sure that it is legitimate. So ask the question, ask for the name, the phone number, the address for the debt collector. You want to get that information in writing. You don't have to accept it over the phone. Ask that they send you something so that you can actually see and verify that you do owe this debt and that it is yours. You want to verify. And then you can also go to the Consumer Finance Gov website, which is where this presentation was taken from, because they have a lot of good information on debt collectors and what to do. And you also want to go to the Federal Trade Commission, and I'll give you that information in another resource. And then you want to know what your rights are. And because collecting bad debt is such a big business, Sometimes people don't know what their rights are and they don't want to answer, they don't want to talk, but we have rights. The Fair Debt Collection Act has information that protects us as consumers. Um, so this slide is talks about what they can and cannot do. The Federal Trade Commission has some articles and good information and blog posting and videos about what our rights are. So you can find out by going to that website to find out what your rights are so that you're not taken advantage of. And then this picture that you see that says clean credit in 30 days guaranteed, this is fraudulent. This sign appears in the metropolitan Phoenix area. It's been over the past few years. I took this picture because I was curious on how does this work? How do you get clean credit in 30 days? First of all, a sign that is printed and stuck and somebody stick it in the ground, that's kind of a alert too that this is not really true. Even if they had an advertisement on TV that talked about this, it still is bogus. This is fraud in the biggest way. I called this number, I spoke to someone, I want to find out how this worked, and they know the law. They quote the Fair Credit Reporting Act. They know the law. They know that if I have a dispute with my credit report, that the credit bureaus have 30 days to investigate that, which is where they get the 30-day guarantee from. Why not guarantee my clean credit for a year or 6 months? They know that they know what the law is. And so what happens is they dispute everything on your credit file, everything, regardless if it's good or bad, they dispute everything. And while they dispute the credit bureaus, they probably take it off while it's being investigated. So the company will go to that site, show me that the information is removed. But if the information is legitimate, it will appear right back on my credit report. And I cannot tell you how many people that I have spoke with in the classes who have been a victim of this type of fraud because they gave some person, some organization, some company $300 to clean up their credit. And within 6 months or 3 months, that item was right back on their credit report. So the bottom line is, if it sounds like it's too good to be true, more than likely it is too good to be true. There is no silver magic bullet to clean up your credit. Cleaning up your credit takes time and it takes money. If there's an issue, and the best thing for us consumers to do is to try to do it ourselves, or if we feel overwhelmed and we can't do it, then we go to a reputable company like a nonprofit credit counseling agency. And we can research companies online by going to the Better Business Bureau, looking up the associations that they are affiliated with, looking for reviews from other consumers to find out whether or not a company is legitimate. So I hope that this information has been resourceful and helpful to you. This is a list of some of the resources that you're going to get. And I hope this information is something that you can use. If you have any questions, please feel free to reach out to myself by emailing communitydevelopment@desertfinancial.com or emailing CD webinars. Thank you so much, and I hope you have a great day.